Have you ever wondered how the current job market situation in the US is shaping our economy? Today, we're going to delve into this intriguing topic, focusing on the recent drop in job openings. Our exploration is grounded in data and insights from reputable sources like Business Insider. We'll examine the factors leading to this decline, such as the Federal Reserve's monetary policy and its potential impact on the economy. We'll also discuss the transition from the Great Resignation to the Big Stay and its effect on the labor market. And we'll explore how changes in immigration could impact job demand and supply. Stay tuned as we unravel the complexities of the job market and its impact on the US economy. As reported by Business Insider, former Treasury Secretary Larry Summers has issued a warning. Summers, a seasoned economist and policymaker, has cautioned the Federal Reserve against hasty interest rate cuts. His voice carries weight as he emphasizes the need for overwhelming evidence of economic slowdown before making such a pivotal decision. Indeed, despite a robust jobs report in November, markets are already bracing for rate cuts as early as March 2024. The situation, however, is complex. Inflation remains stubbornly above the Fed's target, and the labor market shows signs of weakening. Now, you might think this would make the decision straightforward, but it's not that simple. Fed officials have been giving mixed signals on monetary policy. Traders are predicting a 47% chance of a rate cut in March. But while the economy appears robust on the surface, concerns about wage acceleration and inflation persist. Summers advises the Fed to wait for clear indicators of low inflation or a downturn before adjusting rates. But here's the kicker. The cooling trend in the labor market is not the primary factor influencing current monetary policy. Instead, the focus is on managing inflation. Economists are predicting multiple rate cuts in the coming year as the Fed recalibrates its policy, so we find ourselves at a seismic moment, a crossroads, if you will, where the decisions we make today will shape the economic landscape of tomorrow. So is the cooling trend in the labor market a primary factor influencing current monetary policy? Let's explore further. The wave of workers resigning from their jobs, dubbed the Great Resignation, has made headlines for months. This phenomenon, sparked by a myriad of factors including pay disparity and working conditions, led to an unprecedented shift in the job market, painting a picture of turbulence and change. But as the saying goes, the only constant in life is change. And so we find ourselves amidst the transformation of the Great Resignation to what's now being referred to as the Big Stay. A period characterized by workers quitting at a slower pace, the Big Stay is the new epoch in the labor market saga. But don't be fooled by the relatively calm waters of the Big Stay. Beneath the surface, a decrease in demand for new hires is stirring, leading to fewer job openings than we've seen since the peak in March 2022. The need for fresh faces in the workforce is dwindling, casting a long shadow over the future of the job market. The Great Resignation did not distribute its effects evenly across the country. Certain states felt the sting more sharply than others. Alaska, for instance, bore the brunt of the highest resignation rate. Wyoming, Delaware, Mississippi, Montana, West Virginia, Louisiana, Idaho, South Carolina, and Colorado also found themselves in the top 10 states for job resignations in January 2024. But what does it all mean? Well, the decrease in job openings is not just about people leaving their jobs, it's also about the diminishing demand for new hires. As we navigate the ebb and flow of the Big Stay, it is vital to remember the interconnectedness of these trends and the broader implications they may hold for the economy at large. The decrease in immigration to the US during the Trump and COVID eras has had a significant impact on the labor market. As we dive deeper into this topic, we find that the diminished rates of immigration have fueled a number of economic issues, not least of which is a tightening labor market. It's an interesting conundrum. While a chunk of the population advocates for reduced immigration, the data sings a different tune. Immigrants, it appears, have been instrumental in filling job openings and generating tax revenue, thereby contributing positively to the economy. Now let's imagine flipping the script. Increasing immigration could potentially help alleviate the current labor market tightness and assuage inflation concerns. This is because it could balance job demand and supply. It's important to note here that some sectors may stand to benefit more from increased immigration than others. However, overall, It could provide a solution to the current economic challenges without the need for massive layoffs or economic downturns. But of course, we cannot ignore the elephant in the room. Immigration is a politically charged issue, with deep divides in opinion. Yet when we look at the cold, hard numbers, it presents an intriguing option to tackle the looming economic issues facing the US. While immigration is a politically divisive issue, it presents an interesting solution to the current economic challenges. With all these factors at play, job openings in the US have fallen to the lowest level in more than 3 years. This downward trend is not just a statistic on a chart, it's a narrative of our economy, our labor market, and our collective future. The implications of this drop are far-reaching. With fewer job openings, there's less opportunity for the unemployed, underemployed, or those seeking to switch jobs. This could potentially lead to an increase in the unemployment rate, a decrease in labor market fluidity, and even wage stagnation. But why is this happening? As we've discussed, factors such as the Great Resignation and the Big Stay have led to a cooling of the labor market. Many employees are choosing to stay put in their current positions, resulting in a decrease in demand for new hires. This could be due to a multitude of reasons, including uncertainty about the economy, satisfaction with current employment, or a lack of better opportunities elsewhere. The impact of this drop in job openings is also felt by businesses. Fewer job openings mean companies are either not expanding or are finding it harder to replace outgoing staff. This could lead to decreased productivity, slower growth, and even a decline in innovation. But it's not all doom and gloom. There are potential solutions to this issue. One such solution could be to increase immigration. As we've discussed earlier, immigrants can contribute positively to the economy by filling job openings and generating tax revenue. Another solution could be for the Federal Reserve to cut interest rates. While this decision should not be taken lightly, as former Treasury Secretary Larry Summers advises, it could stimulate the economy and potentially lead to a rise in job openings. As we grapple with these economic challenges, it's crucial to understand the intricate dynamics of the job market and its wider implications. In today's discussion, we've taken a deep dive into the US job market and its current state. We've explored the potential seismic moment in the economy that could be triggered by the Federal Reserve's decision on interest rate cuts. We've looked at the shift from the Great Resignation to the Big Stay and how job resignations are slowing down, leading to fewer job openings. We've also delved into the impact of decreased immigration on the labor market, highlighting how increased immigration could alleviate labor market tightness and inflation concerns. And importantly, we've discussed the significant fall in job openings to 8.5 million, the lowest level in more than 3 years, and its potential impact on the entire United States economy. Understanding these dynamics helps us comprehend the larger picture of our economy and perhaps can guide us towards potential solutions. Remember, every economy has its ups and downs, but it's how we navigate these challenges that truly matters.